But I don't know. Right, but why? But it's not. I checked in as an administrator. Oh, you're in go to meeting. You're not in go. They're not in the right meeting. I went to the. It needs to be go to webinar. Oh, oh, oh. All right, I'm good now. Okay, thank you. Yeah. I don't know why it logged me in differently. It automatically went to go to meeting, I think. All right, thank you.
Well, good morning, everybody. We're going to go ahead and get started. We were going to get online. We do have two folks joining us by two of our members calling in this morning. So good morning and welcome to our fourth meeting of the Homeownership Working Group of the Minnesota Housing Task Force. My name is Terry Towell. I'm with Nexus Community Partners, one of the co-chairs, and I'm going to ask our members here to introduce themselves, including the two folks on the phone.
Good morning. Should I start first?
Sure.
Sorry, I'm on the phone here. Hi, good morning, everybody. This is Emily Larson, Mayor of the City of Duluth.
Good morning, everybody. This is Mike Paradise, the other co-chair.
Good morning. My name is Rochelle Taylor. I'm the founding president of NARAB and a realtor with RE/MAX Metro.
Mar, are you on the line?
Yes, I am. And do you hear me?
Yes.
Okay, I'm Mar Valdecantos from North Hill, Minnesota. I'm the chair of the Human Rights Commission and the director of Neighbors United, an advocacy group.
I'm Casey Keir from Minnesota Housing Finance Agency and staff lead supporting the Homeownership Work Group.
Good morning, Merritt Clapp-Smith, project manager for the Governor's Housing Task Force.
Good morning. I'm Mary Tingerthal, the commissioner at Minnesota Housing. Great. And we have.
Good morning, Akua Ellis, one of the co-chairs for the task force.
All right. Well, thanks everybody and welcome. Today's meeting is going to focus on the issue of access to capital. And we have a number of different speakers here, and I'll turn. Our agenda today is to explore more about this issue. Next slide, please. Yes. So kind of, we're going to have a panel talk about about development costs and access to capital. We'll take a break, do some discussions. We've been doing some recommendation work as our goal at the end of the working group, at the end of the 6 months here, is to come up with a list of recommendations, which we've been gathering, and especially after hearing the information today, what can we begin to formulate? We will have some time, as usual, at our meetings for public input, and so if folks are interested, you can send your name up at the desk here or indicate online if you have comments to make. And then talk a little bit about finish up with some of the work group update for our April meeting. So with that, I'll turn it over to Mike to talk about our panel today.
Today we've invited a panel here to speak to us about access to capital. This includes funding for developers and alternative sources of development funding. So I'd like to invite the four panelists to come up. We've got Keenan Raverty, Robin Bipes-Tim, Nicole Beckstrand, Gary Findell. I'll have you come up here, and once you're seated, then we'll give you 5 to 7 minutes to describe your perspective on the topic and potential recommendations you have. And there's no real particular order. We can start on one end and work our way down. Go ahead. Sure. Good morning. Push the button and this will turn green.
Thank you. My name is Keenan Rafferty. I'm with a company called Bell Bank Mortgage, where I manage our mortgage loan retail production in the Minnesota markets. I'm also here representing the Minnesota Mortgage Association, which is our professional trade association, where I'm two-time past president and currently co-chair our government affairs committee. By way of disclosure, I also sit on the board of directors for the Minnesota Homeownership Center and am on the leadership group for the Homeownership Opportunity Alliance here in Minnesota, who I think you've heard from before. But probably my proudest moment here and why I want to speak to you a bit is as a mortgage banker. For the last 25 plus years, I've helped people arrange for home mortgage loans. It's something that I still do every day. I work directly with consumers, and I think that that's an interesting voice only because we have so many talented folks who own and run mortgage companies and banks in this market. And we have many folks who help arrange for mortgage loans. I'm someone who every day wears both hats, and so I'll be speaking a little bit to that. When I think about access to capital, I think about access to credit and essentially the perspective of if a consumer wants money to do something like buy a house, can they get access to that money? So that's essentially what I'm going to speak on, and I'll answer the question before I give some detail. I'm going to say that it's good. Things are good today, that there is good access to capital, at least in that regard. Quick reminder, in the early mid-2000s, we saw really easy access to capital. Credit was free-flowing. People could do a lot of different things, and it essentially was unsustainable. Our markets collapsed really tragically. Fannie Mae, Freddie Mac, which is our two largest government-sponsored enterprises that funded most of the mortgage loans in this country, went insolvent. They're still in government receiverships. Banks are taking TARP money. Things are pretty bad. So as we think about credit on a pendulum, had swung too far. Credit pendulum and the access to capital probably swang the other way as we went into a recession. And of course, people really had a hard time buying and selling homes. Values dropped substantially. It was very hard to get access to mortgage financing at that time, which made it hard to access real estate. We saw homeownership rates drop as a result. So the pendulum swung the other way. We're probably back to a really solid mid-ground right now, where if you want access to capital to buy a home, you need to have a job and an income to support the debt. You need to have a reasonable, not perfect, but credit history. And you need to have some modest skin in the game in order to make that happen. And there's a variety of things that we can look at. But as we look at that balance, I think that that's a good market. I'd like to just tell a little story which I think can help emphasize that, and especially when we think about access to capital, we also have to think about what's the comparative market that we're in. And so if I have a recent pre-approved home buyer that I'm working with who just got out of school, had been working to pay off some debts, and decided that for her situation, it was a good opportunity to get into her own housing unit, move out of her parents' home. She had two options. She could rent or she could buy. She was looking to do something in the Woodbury, Minnesota market, where there's a variety of opportunities for both rental and purchase. And to rental a townhome that would meet her needs, it would be about $1,700 a month. She'd need to come up with a first and a last month's rent and a damage deposit, about $4,000 or so. And she would need to show about a 700 credit score in order to meet the criteria that the rental agency had for that. Alternatively, I was able to show her some options using a Minnesota Housing Finance Agency program where her credit score could go as low as the mid-600s, where she would need to come up with only $1,000 of her own money. And her total payment under that arrangement to buy a similar townhome unit was a little over $1,100 a month, with total all in with dues and that sort of thing, payment a little over $1,300 a month. So for her, she's coming out of this with less cash investment, which can often be a barrier, and certainly a lower monthly payment. So I think we've set her up to be successful in that home ownership if that's right for her. And I think that that example just kind of helped me indicate that access to capital is pretty good. So why doesn't everyone do that? Why doesn't everyone alternatively choose that? Well, there might be some lifestyle reasons why renting is better than home ownership, but the real issue that we face right now is just access to properties. You've heard this over and over again. There's just no inventory out there. So I literally have drawers of pre-approved clients like the one I just mentioned who are out there every evening, weekend, trying to find a property and are just getting beat out in competitive offers. And so that's really just the market reality that we're in. I was asked to provide some recommendation, and I don't know if these are necessarily recommendations, but just as you frame where you're going to come out of as a committee, I would just say that one of the things to realize is just that we are at especially low inventory. So what you could do especially is to make sure that we've got housing units, especially on the affordable housing unit spectrum, to provide. That's really what we need. As we move into a seller market, it becomes especially hard for folks with special financing programs to get their offers accepted. You can imagine in a competitive market, if you have a lot of details to your financing, a seller will just choose some other form of financing that's, or non-financing that's an easier path to closing. I also want to think as we contemplate what additional programs, investments, innovation might be needed, which I think there's always room for growth there. we need to serve certain markets more than others, and we need to be innovative there. We need to really think about how we can make those sustainable. One of the things that I'll give a nod to the folks at Minnesota Housing is they've really worked hard to create a perpetually funded program. But when we kind of come in and out of markets with programs that are here today and gone tomorrow, that they lapse, it's hard for consumers to work with that. I might be pre-approved today, and then 3 months later, when I find the home I want, oh, I guess there's no money available, or they change those parameters. It's especially hard for lenders who are under an incredible burden with regulatory oversight to program their systems and to really make things work when they know that that program's probably not going to be around. So I would just say really look to make that a sustainable way to do it and not necessarily a one and done, throw money at something. And then on that side too, just knowing that in a purchase environment that every offer needs to get accepted, it has to be a program that works for both buyers and sellers. It doesn't have to be seller advantaged, but again, we just need to make sure that we keep in mind that if they don't get their offer accepted, they don't buy a house. And then lastly, I think I'll just mention, don't play small ball. That as we think a little bit about what's going on, we need to think big. We need to think that our mortgage markets predominantly are funded through Wall Street today, that the big government-sponsored enterprises and other conduits are really where people get the long-term fixed-rate money. And so anything that we do in Minnesota cannot disadvantage that at all. If on a national scale they look at Minnesota as being too restrictive, having too many overlays, that's either going to drive up cost of credit or cause lenders to retreat from this market, and we don't want that. Both of those things are bad for consumers in Minnesota. And of course, we are going to be watching. I mentioned earlier that Fannie and Freddie are in government receivership. That's not sustainable. So at some point, we're going to be looking for some GSE reform. We want you to be active in that, to look at saying not so much just how can we do things in Minnesota, but really how can Minnesota help to have a voice on the national spectrum. That's probably going to be the single greatest event in my career as a mortgage banker, and I hope to work a long time longer. But with that said, that's going to change how we view housing. And I do think too that with the backdrop too of regulatory changes that have occurred and potentially may be withdrawn on from a federal perspective, I want to caution us in Minnesota just really to talk to our industry as we see that happening. If, let's say, for example, on a national spectrum, they peel back some layer of regulation, before we just respond and say, holy cow, they're doing that nationally, we're going to have Minnesota respond and have a state-specific law that kind of fills that gap. Let's make sure that we're talking to our industry and our providers to understand, was that really a needed regulation? Was it serving what it was supposed to? And is that void really going to be impactful? Because we just don't want to do anything that would distinguish Minnesota specifically different than other markets. And with that, I'll close and pass to the next panelist. Thank you.
Good morning, everyone. This is Robin Bipes-Tim. I am the Vice President of Twin Cities Habitat for Humanity, and I am the President of our mortgage company. And I'm really glad to follow you, Keenan. I think some of the comments that Keenan made were right on target about what is happening in Minnesota. We do have good access to credit. Not everybody has the same access to that credit, and so I'm going to speak both from Twin Cities Habitat for Humanity's point of view, both what are we seeing as availability for credit in the mortgage market and also as an affordable housing developer. So I did go ahead and put together some slides. Habitat is a big visual organization, so I'll walk through these. Okay, so just thankfully, I think most people have heard of Habitat for Humanity. I'll maybe just frame it up really quickly. Our mission is to eliminate poverty housing. Our Twin Cities Habitat affiliate service area is the 7-county metro, so all 7 counties, and we work in 58 different cities. We are not alone, though. There are 1,400 habitats worldwide, 1,300 in the United States, and even just here in Minnesota, we have 30 other Habitat affiliates. Habitats are really locally based, very organic. Many habitats began in church basements. And the thing that I would say is Twin Cities Habitat is one of the largest habitats in the nation. top 5 in terms of production. We build 50 to now 100 homes a year. We have 16,000 volunteers. We have a lot of experience as both a builder of starter homes, an educator and a financial coach for families becoming first-time home buyers. And we provide affordable mortgages. Not everybody knows that every habitat provides its own mortgages, so we are a mortgage lender. So I want to kind of both speak to that mortgage lending gaps in the market and what kind of access to capital we need as a developer. I'll just pause really quickly on this. We know, or the governor's task force knows, that housing costs are rising while incomes are not, and that is really creating the gap that we need access to capital for. As Keenan mentioned, and as previous panels have mentioned, we have very low supply of starter homes. And even as Habitat, we build as many homes as we possibly can. The availability of land to build those homes and the availability of capital to really make those homes affordable, it really is the only thing that restricts our growth. We would love to be able to build even more, but it's really access to capital that kind of keeps us on the edge. And then really important to us is the racial gap in homeownership that I know the task force has taken a look at, but Minnesota has one of the highest gaps in homeownership between households of color and the general population. Why this matters to us is that more than 90% of the households that Twin Cities Habitat works with are households of color. So 90% of our first-time home buyers are households of color. Everyone is a first-time home buyer, so we're all talking about starter homes here. The average family size is a family of 5, and our families get much larger than that too. And everybody with Habitat and with anyone who gets a mortgage really has a job. So this is workforce housing. Everyone is working. Many families are working multiple jobs. The average income of the families that we work with is $45,000. I'll skip over this really quick, but I think it's really valuable that homeownership really matters. We did a study with Wilder Foundation about the benefits of long-term homeownership, and 91% of the families felt better about themselves and their kids' future once they became a homeowner. There was a 40% reduction in going to the doctor. 92% of adults who are Habitat homeowners went back to school. So really, housing and stability is a really important message. As I said, access to affordable capital is our biggest barrier to growth. Over the last 30 years, this is a chart of how many homes Habitat Twin Cities has built. We were building up to about 30, 35 homes a year, and we realized that access to capital was the one thing that was preventing us from doubling our production. So we have set out a really ambitious goal. Our board has set a goal to double the number of families that we serve by 2020. This is part of our Impact 2020 goal, and we will serve 500 homeowners in those years. And so that, instead of 30 to 50 homes a year, that's a production of 125 homes a year. I'll get into how we're doubling that. Basically 3 ways. As a home builder, we are not only building new homes, we are now actively going out as a cash buyer of existing starter homes or homes that are priced around this is Twin Cities, so homes that are priced, below $235,000, $245,000. The reason that we're doing that is we know that a lot of investors have been active in this space, and we really wanted to be able to, using Habitat's name and our ability as a cash purchaser, compete and acquire some of these properties and make them affordable for people who, but for our ability, wouldn't be able to compete on the market and buy that home. So we started doing this a couple of years ago, actually, with Minnesota Housing's TMOP program was our pilot. We sort of got our feet wet in becoming an ACK rehabber of properties. And it's really working well for us. We've acquired 35 homes already just this last year. Many of them below the $240,000 mark. We're able to put some rehab dollars into that, and then we're able to partner with the families who are in our pipeline to really show those homes to them and help them, get into these homes where they would probably not have the same opportunity to compete in the general market. We know that families are sometimes putting in 15 different purchase agreements to get the home that they want. And Habitat's name and, again, the cash that we can bring to the table really help that. But we need access to good capital to allow us to be able to acquire these homes, and I'll get to that in a minute. So that's one of our strategies. The other strategy was, oops, sorry, go back. We've always been a mortgage lender, but we really took our mortgage lending to scale. We created a wholly owned mortgage company in order to better meet all of the regulations of mortgage lending. As Keenan was saying, we really wanted to access the capital markets in a better way. So 2 years ago, we went from originating mortgages and carrying them on our own balance sheet to partnering with banks. So we originate the loans and then we sell the loans to Bremer Bank, and we do it in partnership with Sunrise Bank, who is our originating partner. And that really freed up a lot of capital for us. I'll get into that a little bit more. And then the last thing we did is we really doubled down on our home buyer help. We added one-to-one financial coaching to our education, so we're working upstream with families years in advance to really get them ready for homeownership. And with the hot market, we needed to double the number of home buyer affordability gap and down payment assistance, because we realized that while housing prices have gone up, wages have not gone up, which means it's more important that we come to the table and help families with that down payment assistance. A lot of the families we work with do not come from families that might have parents or grandparents who can help with that down payment. And so we kind of step in and, you know, I think one of our donors said we're kind of like the grandparent who can step in and help with that down payment assistance, and that's hugely important in this tight market. And then there's just the challenge of starter home math. I know this committee has talked about the fact that to build starter homes right now, because of construction costs and because of labor, to build it, you're upside down on what you can actually sell that home for in certain markets. And so I'll talk through a little bit of the access to capital we need to make that work. So all these strategies are very capital intensive. As a developer, this is sort of an image of why we need so much capital. So we, in our new model, need about $30 million a year in construction revolving capital just to go out and to buy all that land, to buy all these homes, to build and rehab the homes, you know, during a 12-year construction cycle or 12-month construction cycle, and then to sell the homes to Habitat families. The challenge, I think, for a lot of nonprofits is that to find financing that really works for our business model, I mean, financing that can be patient and allow us to go through one construction season and maybe even a little bit longer as we continue to prepare the families for home ownership. We want to make sure that that family has gone through all of its coaching and all of its education before they close on the home. And some of our takeout financing is not just the mortgage, but it's also the subsidies that make that home affordable. So we need to find construction lenders who can really support that work. And this is going to get even tighter with rising interest rates. For example, right now we borrow a lot of our construction capital from banks, and that's been fairly affordable at 3%, 3.5% interest. But in a rising interest rate environment, we are going to bear the interest rate cost of that, and we do not pass that on to the homeowner. We don't really have the capacity to pass that on to the homeowner. So it's our model is really going to get restricted as interest gets tighter. Go ahead. So one of the things I want to just mention is, I think I mentioned that we sell our loans to Bremer Bank now. The reason we did that was that we created our own Habitat mortgage product. And the reason I bring this up is that access to capital, as Keenan said, is good, but it's not accessible to everybody. And we realized that while there are great FHA and Fannie Mae programs and even conventional programs, a lot of our families don't have the credit score or the work history, et cetera, to quite fit into that box. And so we created our own Habitat mortgage. And when you create your own mortgage, you have to create your own secondary market because there is no investor national platform to buy those loans. So we have worked over the last year or two, like I said, with both Sunrise Banks and Bremer Banks to buy our loans. And it really is a flexible model that allows us to originate where we think there is a gap in the market. And I think the next slide goes over what that is. I'm sorry, my voice is a little sore. We had our Habitat Gala on Saturday night, and I was whooping it up. And so I realized I kind of have a sore throat, and I'm catching myself. So what does the Twin Cities Habitat mortgage look like? And I just want to pause on this for a second because, again, we realized we needed to create a customized product that really helped meet some families who, but for us, would not be able to access homeownership. So we size our monthly mortgage at 30% of a family's income, which is considered the industry standard. You don't want to have someone, thank you. We developed our mortgage underwriting based on FHA, but with some more flexible features, including credit scores going down to 620. An alternative credit path. A lot of our families are immigrant households who don't yet have credit, and they have good jobs, and they've been in the country for many years, and they have really stable incomes, but they have not yet accessed or thought about credit in the way that we do. So it was really important for us to create a underwriting path that would acknowledge the family's hard work and their stability of job the same way anyone else who might have credit. And really importantly, we have a more flexible view towards work history. So low-income families change jobs a lot more often. And oftentimes our families are changing jobs because they are moving on to get a better job and to get more income. But that also means a little bit, I mean, there's more job changes there. And, Keenan and Nicole can talk about what mortgage traditional approaches are, but normally you want to have someone in the same job for a year or more. And that doesn't always fit with, families are moving jobs a lot to move their family up the ladder. We also built in a 203K rehab option. I know we've talked about, not all housing stock is ready to move in. So we have our mortgage allows a family to move in, and then we'll do up to $30,000 of rehab on that for them, which is really helpful. We don't require mortgage insurance. Again, we created our own secondary market, and so we were able to do that without the mortgage insurance. And then we require a $50 monthly savings for repairs, because the one thing we found families really need is that predictability. I mean, it's one thing to get into the home, but then you really have to be thoughtful about planning for the long-term home ownership. And so this $50 monthly maintenance fund we found is really successful. And all this to say, our foreclosure rate within our portfolio is less than 1%. So that's really fantastic, thinking we're working with all low-income households. And then I just put this together because sometimes it's hard to describe how affordable housing works. But for those of you on the phone, I'm looking at the screen that has the little house. Basically, the gray box in the middle, the affordable first mortgage, that is the Habitat mortgage, which is sold to Bremer Bank. And as Keenan said, private lenders really are providing most of the capital for affordable homeownership. I mean, the first mortgage is 60 to 80 to 90% of the entire value. So I think homeownership does a wonderful job leveraging the private market. But to make that private capital leveraged, we really need the affordability assistance, which is the hat on the house. That's that 20% down payment, sometimes more depending on the family income, that makes the home affordable. And then on the bottom, like we were talking about, it costs more right now to build starter homes. And so that's the subsidy needed. Down payment assistance and value gap are both needed to build the starter homes and attract private capital. And so I'll just leave with three recommendations, which I think are really glad. I mean, they look a lot like what Keenan was saying too. We really could use a statewide pool of down payment assistance that's more predictable, reliable, and accessible year round. As Keenan was saying, sometimes programs change year over year, and that's hard to plan for. And other down payment assistance programs may just be geographically specific, so they don't follow the family. So if the family's looking in Brooklyn Center, but then they're looking in Brooklyn Park, they no longer qualify, and then you're having to spend a lot of time giving, updates to that. A really accessible statewide pool would be great. We could use more flexible underwriting products like the Habitat loan that are built with the good bones of lending practice, but that meet other markets and other populations that are underserved. And then local trust funds, we really love this idea because we really need the local and the state dollars for the subsidy to make the home ownership possible as a starter home developer. And I think I'll leave it at that, and we'll get to more questions.
Good morning. Is that good? Can everyone hear me? So my name is Nicole Beckstrand, and I am the president of Sunrise Banks, and I'm delighted to have been asked to be on this panel. I just want to share a little bit of my background and maybe why I was asked to be on the panel. I currently sit on the board of Habitat Minnesota, which is the service organization for all the Habitat affiliates. So I get to see a little bit about housing across the entire state, not just in the Twin Cities. I'm also on the Family Housing Fund Board and an advisory member to the LISC group as well. I'm going to talk a little bit about individual home ownership, but also the developer arena, because as a financial institution, we do a large number of development loans to affordable housing developers. So I think that the general, let me first start and talk a little bit about the products that Sunrise has offered on the individual mortgage side. So about 2 years ago, we developed our own mortgage company, specifically focused on the urban core of Minneapolis and St. Paul. So what we finance mortgages to what I would consider the most financially vulnerable individuals in the Twin Cities. And some would say, why are these individuals getting a mortgage? And oftentimes I have to educate individuals to get them to understand that by putting them in a home and creating that stability for their family, we're actually bringing down their housing costs. Many of these individuals are paying, well above their mortgage in rental fees. And so the stability of the family, as Robin has mentioned, the Habitat study that was done a couple of years ago really talks about the impact on families and homes. So we created a mortgage company focusing on the most financially vulnerable in the Twin Cities. We actually have a lender credit program that we fund ourselves as a bank that allows for a lender credit to be provided to the individual either based on AMI or based on location. And we really like that. And it could be based on both as well. They could qualify lender location-based and they could qualify AMI-based. And what I really like about that is that I think it gets to some of the individuals that aren't receiving those credits. And it is a lender credit, so it is forgivable. There is no repayment of that lender credit. In addition to the lender credit program that we offer, we also have established a ITIN mortgage program, and I believe probably the only active ITIN mortgage program right now in the state. And so we do go out and do a large number of presentations and education around mortgages within the Hispanic community. We do have alternative credit criteria for them because many of them don't have a credit history, and so we're doing alternative credit checks. Lots of education along the way. And we're also working on creating that secondary market. I'll talk a little bit about secondary markets in a minute, but we're also working on creating that secondary market for those mortgages. One of the things about our mortgage company when we created it, I said, is that we would hold and service all of our loans. I think that's really important as we went through the financial crisis. I think the one thing we saw is those that were financially vulnerable were impacted the most because they really couldn't navigate the process. They couldn't navigate help, even though they wanted it. And so it's very important to me that these individuals have a bank location that they can walk into and say, I need help, not a 1-800 number. In addition to the ITIN mortgage, we established a credit builder CD program that allows individuals to put money into a CD to save for a down payment on their home. And in turn, they're improving their credit score as they're making payments on a loan. The beauty of this program is that if they make all of their loan payments on time, we will forgive 50% of the loan interest on the loan. So this is definitely for the bank. It's a very loss leader type of product. But the beauty of this is that teaching individuals the rigor of making a monthly payment is so important, so that when they get into that actual mortgage, they're used to setting that money aside. I've done some national survey research on this, and the Center for Financial Services Innovation found that most credit builder programs had a 40% default rate, meaning people got into them but didn't sustain them throughout the time of the program. At Sunrise Banks, we have a 9% default rate on that program, which to me tells me that that incentive for the interest forgiveness on that loan is really working. So we did over 365 of those CDs last year. Again, as Robin had mentioned, we are the originator for Habitat Twin Cities loans. And I want to talk about the secondary market, because as we create these products that we feel the market really needs, it's really difficult for community financial institutions to do that. It puts a lot of pressure on our balance sheets. And our regulators look at those as not sustainable models, right? So we're looking to create a 30-year loan program and lock in some interest rates. But yet our regulators come in and say, no, 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 you can't do that. You're taking too much interest rate risk as the market evolves. So Bremer Bank and Sunrise Banks in the Twin Cities are very uniquely positioned. And so I think if you look to other markets, you would probably not see as much creativity around these products. Because Bremer has a foundation, they're able to leverage the money of the foundation and hold those loans on their balance sheet. Sunrise Banks happens to be in the prepaid payments industry on our commercial side of the bank. And so because of that, we garner a lot of 0% deposits. And so we're able to leverage that 0% money then to loan out at lower rates to the community. So that brings me a little bit to the developer side of things. So we have done low-income tax credit projects. We have done new markets tax credit projects. It really does require these government programs to keep these loans affordable. Sunrise Banks is a community development financial institution. It's otherwise known as a CDFI, which is a U.S. Treasury designation. And by being a CDFI, we're given access to the new markets tax credit program so that we can leverage these government dollars. And they're not easy programs to administer. They're difficult and they're time consuming, but they're so necessary in order to get that money into the community, into the developers' hands. I think one of the things I've seen is that on the affordability side, there are a lot of smaller developers looking for access to credit, willing to maintain affordability, that are commercial investors, not nonprofits, that are having trouble getting that capital. And I think it's just, as a regulated institution, there are required loan-to-value ratios that we have. It's easy to do the large project and get some low-income tax credit and some new markets tax credit and do it with the large developer. It's much harder to do a smaller project for that smaller developer that wants to do it. So, one recommendation might be if we could create some funding that maybe had a little bit less rigor and complexity around those programs so that we could get some money into those hands so that those transaction sizes didn't have to be so large. I think we could make an impact. Again, there's no single solution around this. I think as a community financial institution, we look to partner with nonprofits, with government agencies, with other financial institutions to deliver products and services to the market. On the global scale of things, we see, from an affordability standpoint, we see housing prices rise, but you also see just the cost to housing rise in general, and incomes are not going up. So I think when we think about affordability, we have to think about investing in energy saving opportunities that will allow the cost of housing to either maintain steady over the future years. I think, if we can find a way to reduce or eliminate property tax increases for projects that commit to affordability. Again, I know that's a revenue stream for the counties, but it might be a way that we can keep the operating costs of these units down. I think as developers are looking at doing projects, I know the market wants diversity of the housing projects. They would like some single family, some duplex, some multifamily. The developers run to the multifamily large units because it's much easier for them to maintain those operating costs. I think we've got to think strategically about other ways that we can hold operating costs down for them so that we can get some diversity of the housing stock. I would echo the comments of the two previous speakers. Is the housing stock is the biggest challenge right now. Our list of pre-approved buyers is, 3-4 pages long when I look at our mortgage reports. And it's really about helping them find the right property and be quick to the market. So, I'm kind of rambling here. So Sunrise Banks is actually looking at developing a community development corporation, a CDC, which will be a sub of the bank. We'll be announcing more details soon, but we're going to put $45 million into this CDC at a 0% interest rate. We're hoping to be able to acquire 1,200 units of affordable housing through partnership with local nonprofits. And that's just a smidgen of the marketplace. I mean, on any given day, we're 5,000 plus units short of affordability, and we're losing ground every single day. So we've got to think innovatively about how we can do this. So we've got to work together. Thank you.
Good morning. My name is Gary Findell. I want to thank Merritt and Casey for inviting me here. I also want to thank the three previous panelists because they've kind of been a great introduction to who I am and what we do. I'm a partner of a company called Smart Homes, LLP. Smart Homes was started almost exactly 2 years ago today. My partner is a guy named Richard Copeland. Richard is the founder and chairman of Thor Companies, who I think is still banking at Sunrise. And Richard and I've worked for Richard for about 12 years prior to going into partnership with him. And we saw a real need, primarily starting and focused in North Minneapolis, on more market rate infill housing to fill a need for new homes at a price under $250,000 for the most part, first-time home buyers. And it was a market that really was not being served in the urban areas. There were very few market rate new homes, or still are very few market rate new homes being built. A number of people told us this. We're a little naive and maybe arrogant in thinking that we could do this, where a lot of other people had tried and failed. Our accountant keeps reminding us that we are a for-profit company, not a not a nonprofit. But I'll talk about a few of the issues and difficulties in trying to build these houses and making a profit. I'm going to start by talking about access to capital. I'm going to close by going into more about some of the development costs and issues associated with development costs. This year we'll build about probably 40 new homes. Our typical buyer is in their late 20s, early 30s. Very typically it's a mixed race couple, or other than that, it's people looking for a new home in an urban area. They don't want to live in the suburbs or exurbs. They want to live as close to all the amenities of the city as they can, and they're just finding very little products for them. We're building houses that are affordable to first-time home buyers, but we're not really building affordable housing. But I think we are making an impact or potentially making an impact on the affordable housing issue, because a lot of these people were currently or had been living in housing that was less expensive, and when they bought our new houses, I think they made their homes available to people that probably weren't quite ready for a new home at that above $200,000 price point. To date, we're entirely self-financed. All of our operations we've financed ourselves. We have a construction line of credit from the Twin Cities Community Land Bank, and which is great. The issue with that is that every time we take out a loan, we have a master credit facility that we closed on, but every time we take out a loan on a particular project or house, we have to then close on the financing for that house. So we have the closing costs that range between $300 and $4,500 each time we get construction financing for a particular home. And with our margins and in this market, that $3,000 plus or minus a lot is real money. It is a big issue. We also, the land bank, because of the source of their funds, there's income limits on who can buy the homes. So we've had a number of buyers that are actually overqualified to buy our homes, which is a little surprising to us and I don't want to say disappointing, but that's just the reality of it. Right now, we can sell every house that we can build. And if we had access to I don't want to say easier to use financing product, because the land bank does make it very easy to use, But again, the time and the other issues and the money involved in, taking out a loan every time we're building a new house, they add up, and they really don't, they make it harder and harder more difficult to be sustainable than it should be or than it could be. So if there was and I think Robin talked about this, some sort of I don't know, I can't remember the terminology used, but a revolving fund of some sort that we had access to just for construction financing. We have a lot of buyers that come to us, they're pre-approved. Some of them actually have a perm to construction or construction to perm financing that works out great for us, but most of our buyers come pre-approved with a conventional mortgage. So we have to find financing or provide financing for them on our own. The land bank is one source. Otherwise, we've been internally financing them, which is, we've pretty much reached our limit on what we can do there. But if we had access to a fund that we could borrow from to build the home, not to run our operations or anything like that, just to build the home, we could easily double the 40 houses that we're going to build this year to 80 or even more. Interest rate, right now we pay a 7% interest rate to the land bank. We could get that a little bit lower. But again, it's really the time and the closing costs for each individual loans that's more of an issue for us. Now I want to talk a little bit about development costs, because there hasn't been a whole lot of discussion about that. There's an interesting editorial in the paper yesterday from Peter Coyle from BATSE, the Builders Association of the Twin Cities, laying, I don't want to say blame, but placing a lot of the responsibility for increased housing costs on regulations. And there's a lot of truth to that. But as builders, I think we are not doing what we need to do to really embrace new technologies that could lower the actual development or the actual cost of construction. He's got a number of recommendations in there on what can be done, and none of them have to do with innovations in construction. The construction industry has been the slowest to embrace new technologies to increase productivity. In fact, I think our productivity has maybe gone down over the last 10, 20 years, while most industries have seen a pretty significant rise in productivity. So we're looking at a bunch of innovative techniques to build houses. We use a modular housing product that allows us to build a house in about 2 months from excavation of foundation to CO. That brings our lending costs down if we're just paying interest. It makes the buyers happier. It makes the construction lenders happy. It really makes the neighbors happier, because they don't have 6 months of disruption. They have 2 to 3 months of disruption. And there's some related technologies associated with modular building, which is the same International Building Code that all builders use for the housing. It's just built inside of a factory instead of on site. So we're having conversations with our provider, Hennepin County, and some others in developing a facility here in the Twin Cities. Right now, the people we work with are in Detroit Lakes, Minnesota. So I think the construction industry in itself has a lot they could do to help reduce the cost of construction. We're not going to change the regulatory burdens overnight. I mean, even over years. Plus, the idea of reducing regulatory burdens, which has to do with safety and stuff, for affordable housing and not for others, which is what some people have talked about, seems kind of contrary to what we would hope for. I'll stop there. Thank you.
I'd like to thank all of our panelists today. We're going to open this up for questions. We'll start with, we have 2 of our members on the phone. Emily and Mara, do you have any questions for our panel?
Hi, this is Emily. You know what? I don't. I thought it was a really great discussion. I thought you really covered a lot of important things well. I'll be curious to listen to the discussion there. It's hard to participate so actively over the phone, but the idea of the housing trust and simply just how to fund some of those concepts, that continues to be the thing that I'm not sure how we get to, but no, thank you very, very much.
Mara, do we have anything from you?
I can tell you how to fund the Housing Trust Fund. We have to go after the donor advised funds from the foundations. That's where the money needs to come from. The local foundations, the donor advised funds. there's a lot of money in donor advised funds in the Twin Cities, and I think this needs to be sold as the biggest impact area. I think the hesitation is that when the impact is a long impact, you don't see the impact immediately. So I think the foundations are hesitant to put donor advised funds into affordable housing because of that. They want to be able to report immediate impact on a year-to-year basis with those donors. But we have to start thinking more proactively than reactively as a community.
Yeah, my question is for Robin, just because, or any of the panelists, we've had a little bit of a Twin Cities focus here. I was wondering what you could share some of your observations around the state, in particular in terms of access to capital and underwriting standards. I appreciated the story you told about Habitat's product, and I assume that's based on learnings over the years. What are you seeing on a statewide scale or hearing from the other affiliates?
I apologize for my voice again. Yeah, I'm from Mankato. And before I joined Habitat 2 years ago, I worked almost 10 years at the Greater Minnesota Housing Fund, where I was the director of lending and programs and finance. And so I have a big passion for rural and greater Min and what are the credit needs there. The one thing I'll say is in greater Minnesota, you have a lot more fix-up funds needed, a lot of aging housing stock. And I think at one of the subsequent meetings, this group is going to dig into what are the fix-up solutions that we need, a little different than, first-time homeownership. But to be honest, one of the things we noticed was statewide, while you might think that there are real big differences in construction costs, there aren't. I mean, I think the pressures in greater Minnesota to be able to build affordably, starter homes, similar, cost of construction, and really similar labor costs. I mean, it's not a lot cheaper to build in Greater Min, especially when we lost a lot of the labor force to what was happening in North Dakota. I mean, it was really hard to find the tradespeople to do it well. And so it's worse in Greater Min in a way because those costs are the same, but the appraised values of the housing stock are lower than they are in the Twin Cities, so you see even bigger gaps. I think we would like to figure out some statewide solutions. Right now, we are only doing our Twin Cities Habitat mortgage product in the Twin Cities. We have a great relationship with Habitat Minnesota, which is a statewide organization, and we're talking about whether we can help make some of that kind of mortgage capital available in other parts of the state. And then I would say there's a lot of innovation happening in Greater Min. There are a lot of strong developers who have like a regional focus who are struggling with some of the same starter home math that we are. The greater challenge would be some of them are even smaller, as Gary was saying. So the availability of revolving capital and cheap capital that you can rely on when you are a smaller developer. You don't have access to some of the bigger sources of financing. So in short, really similar situation, but probably more exacerbated because the appraised value of the housing stock is less.
If I could add quickly to that, when we first started, we first set our first house. It's kind of cool to watch because a crane comes in and these houses float through the air. So we had some TV coverage on that, and we got calls from Duluth, Rochester, Mankato, Morris, in addition to the entire rest of the country in terms of whether or not this is a model that could work in their communities. Like Robin said, the labor force in construction, especially smaller scale housing construction, it's disappeared in a lot of communities. It's tight here in the Twin Cities, but it's much worse outstate in other areas, and that just leads to increased costs and to be honest, lower quality.
Thank you. I have a couple of questions. I think I have a question for each one of you. So maybe we'll try to keep the answers as short as possible. See if I can get through them quickly. Keenan, you never mentioned appraisals. Is that an issue?
It can be, yes. Yeah. I don't know if you want a short answer, but yeah, ultimately, and this is, I think it can be an issue, and I'm not sure that some of the creative solutions are hitting the point. For example, I know one of the pieces of supplemental information you were sent in your packet prior to this was about the FHA 203K loan, yep, which allows a borrower actually to finance up to 110% of the appraised value. question to the panel or to this group is just, is that really the right thing to do for a consumer, to allow them to over-improve their home to where they have a $200,000 house, and we're essentially saying you can finance $220,000 coming out of this plus your financed mortgage insurance. So I would just, to your appraisal point, we want to know what that value is, and that's an important responsibility not only to the mortgage lender but also to the consumer. If their job changes or something else and they need to move and they're upside down in their home, that could put them in a bad position. So appraisals are an issue.
The other question I have for you is interest rates. Everybody talks about them going up. Is there any type of product or a need for a product to buy down rates to keep these houses affordable? Is there anything in the works on that?
Well, the two things in the affordability index are the cost of credit and the cost of housing. So as home prices continue to go up and cost of credit goes up, that's going to be a problem. What is yet to be determined is just how that will be offset by other things. One of the things that historically we'd want is a nice, robust economy where people feel like I've got a good paying job and I've got some money in the bank and a good retirement. And so as those things come up, they could potentially be an offset to those. Now, we haven't necessarily seen that, but that would be, of course, a hope.
Thank you. Robin, I had a question for you also. You talked about you were building 100 homes per year. That's all in the metro area, correct?
Yeah, and to be clear, we're building about 35 new construction homes. We're rehabbing about 45 to 50 homes. And then we also made our mortgage product available on the open market, really, so someone could just shop like a regular mortgage company and buy an existing home. And that's really having a big impact on how many homeowners we can finance. So even if we're not building the home, we're providing the affordability gap in the mortgage.
Where are you finding the projects for these? Is that an issue?
It is an issue.
Are you doing any developing?
We are doing a lot of developing. We do about 50% of our development in the core cities of Minneapolis and St. Paul. But as far as, remember how I was talking about we're becoming sort of an acquirer of homes using a cash buyer model? We're doing that really in the first and second ring suburbs because we want to give families more choice on where they live. And we're actually finding that we're able to acquire quite a few homes, I would say like Richfield, Brooklyn Park, Brooklyn Center, sort of first and second ring. That's really where we're able to find the housing stock that's still available in the 225, 250 range. We would love to be able to find in more communities, but of course some of the communities are financially out of reach even for us.
Okay, I'm more interested in the development part. Well, I'm interested in it all, but right now, my question goes more to the development, you know, pocket neighborhoods, small projects. Is there some type of model that you have for that that could be used statewide?
Yes, it's a longer answer maybe, but I think one of the things that Gary was mentioning, so we have a panel plant. So because we're such a volume builder for a habitat, we have a warehouse and a panel plant where we're actually building all of our panels and we're shipping them on site. And we've played a lot with modular home construction and Optimin and lots of different innovations. We haven't seen the cost of modular housing work quite for us yet, partly because of the transportation distances for where these modular, businesses are. And I think that's a great opportunity. If we had something closer to the Twin Cities metro, that could really make a significant impact on the cost of those homes.
And I have another question here for both, well, actually, for Robin and Nicole. Nicole, you mentioned that you work with 1,200 units were built with local or created with local nonprofits. Is there any programs with private industry out there for either one of you?
We currently don't have, we finance developers, right? We currently don't have any partnerships with private organizations to do the development work. We are working on, we are reaching out to the foundations to get them more invested at that level. But yeah.
And I'll really quickly say we partner with for-profit developers all the time. We'll often do, so Habitat, we do standalone single-family homes, but lots of townhomes and lots of twin homes. And honestly, we prefer twin homes in a way because the townhome developments and the Homeownership Association dues are really hard for low-income families to predict. So what we'll do is we'll partner with a single family developer, for example, Sherman and Associates, who they might be building out a development and they might do some of them market rate and we'll do them affordable. Or when we had different subdivisions kind of collapse during the market, we stepped in and built out those subdivisions, et cetera, when the private market failed.
Mike. Mar has a question on the phone.
Yes, thank you so much. I'm sorry that I cannot be there in person. I would love to be there. Wonderful panel. My question is, when we talk about the gap for people of color, and we're learning that Minnesota is very bad about it, and that there's 44,000 people that it could be in housing ownership, and they can't. And I wonder if you can explore and talk more about what are the obstacles. And it cannot be only the credit score. There are other pieces here at play. Maybe when they go to the bank doesn't trust this specific family at some point because they're people of color. Maybe the real estate companies, they still have the mindset of, it would diversify a neighborhood, people will like it, and they will think that the price of their homes will be lower, and all that background, right, of decades of subtle and not so subtle discrimination and segregation. And then the other thing is, I'm in Northfield, a rural area, and in this task force, I'm so envious of all the wealth of things that the Twin Cities offers that we don't have in the rural areas. We don't have those financial assistance programs. We don't have many things we're learning in those sessions. And for Sunrise Bank, for instance, will you expand and go to the rural areas as well? I mean, open your bank to the other. I mean, we need banks like you. So that's also part of the question. So thank you so much.
Well, that's a wonderful compliment. And I would say that if community banks are doing what community banks were meant to do, you would probably already have an existing Sunrise in your community. But, I think from my perspective, I've just recently hired 3 additional Hispanic mortgage lenders or account reps, basically. And I think that's important. I think it's also important that when we meet with a borrower that's looking to buy a home and they're not ready, they're still our customer. So we spend, our bankers spend a lot of time with them talking about what they need to do to get ready, and they work with them. So we have, we have customers that we met a year ago that were coming in on a monthly basis to talk about their finances and stay on track. And now they're coming back in and they're ready to buy a house. So it's not the not now and we send them away. It's the not now and here's the plan that we're going to work with you on. So most organizations won't do that, and it does take a lot of time and commitment. But for us, it's the right business model, and it does pay off. And these borrowers are committed to doing the right thing. So I think there is a distrust out there in the community against banks for from individuals. We also go to a lot of churches, and we go to trusted agencies because we know that we're not the trusted entity, and we seek to develop those relationships. So we're out at some of the local urban churches talking about financial education, talking about products that they can help increase their credit score and how they can get to home ownership. And then eventually they trust us enough after seeing us at their church that they'll actually come into the bank and sit down and share their financials, and we'll go through with them what that path could look like. We're doing that, in churches. We're doing that in partnership with Prepare and Prosper and the Eastside Financial Center. And so we know that we're not trusted, and we walk into that relationship knowing that we have to get over that hurdle and rely on a trusted partner to make that first introduction. And eventually they'll come around, and we get to sit with them and work on that plan.
Nicole, that brings up a question.
No, you can finish, Mike. I just want to
just on that issue real quick. I actually sit on the board of a local community bank, and they're small. They don't have the resources that you have. What would be interesting, though, is your programs that you're using, and can we scale them down and take them out to greater Minnesota? And can we somehow provide a resource to teach these other community banks some of the programs that you're running?
Yeah, I think the key to the programs is having access to the programs, right? So we get access to a lot of these programs through our CDFI certification. So we have the ability to file for what's called Bank Enterprise Awards. So over the course of the time that I've been at Sunrise Banks, we've actually been the recipient of $18 million in Bank Enterprise Awards. That's all money that has gone straight into community education, community service, that helps keep our model working, right? Now, we're not just given that money. We have to prove to U.S. Treasury every year when we apply for these grants that we're using that money in the community. We have to report. So it's a very robust program of reporting how we're impacting our community, but it's very worthwhile. So that CDFI status is really important to us. The other key, I think, is that we are singly owned by one individual and one family, and they are a social enterprise. So the required return that they mandate from us as a financial institution is much less than a typical financial institution would require, right? I mean, the Riling family, if they were a typical bank ownership family, could make a lot more money than they do, but they have a goodwill, do good goodwill model. And so we're able to give more back and do more with our dollars. We're able to increase our donations, increase our investments. So yes, it would be great if all banks could run on this model. I'm just really lucky to work for the one that does.
I have two comments and then two questions for Gary. First of all, I do want to comment on this lesson that we've been learning, I think all of us over the last 3 years or so, about the need to put money in that longer term education. That if we're really going to close the gap in disparities in homeownership, it really does mean being willing to put the money on the table to start with families 2 or 3 years before they're going to be able to buy that house. And we started our homeownership capacity program with resources from Minnesota Housing 4 years ago now. And we have over 2,000 households through a variety of programs that are in that pipeline. And we have a very high success rate in terms of families going forward with an actual home buyer purchase. And it's delivered, as Nicole was saying, through organizations that are trusted in the community. And, of all the things we've done in the last 5 years in terms of working to close that disparity gap, I put that at the very top of the list. The second thing that I would say about Sunrise Banks, I do a fair amount of work with CDFI banks, and Sunrise is in the top 1% nationally in terms of how well they use that franchise. So we're very, very fortunate to have them. And I'm not just saying that because Nicole's sitting here. It really is true. So that gets to my two questions for Gary, and I'll ask you both of them, and you can answer them in either order. The first question is, I'm troubled by your comment about how difficult it is to borrow on a secured basis, because as probably a lot of people in the room know, construction lines of credit to developers are notoriously risky. They're the first thing to go down the tube when you have a downturn. And we've talked at previous meetings about the fact that the standards have gotten higher and higher, and Nicole mentioned this, for being able to borrow. And maybe not here, but at some point I'd love to brainstorm about how do you reach some more middle ground around that makes, addresses the very high risk of development lending, while at the same time tries to streamline it somewhat. So that's my one question. What ideas do you have for streamlining? The second question I have, I've been doing a little research on the whole idea of modular or what can sometimes be called off-site construction. And one of the things that I read is that in order to successfully invest in a factory, which is very expensive up front, that you really need to have some dependability of pipeline if you're going to actually make it work from an economic standpoint. And I've seen some builders in other parts of the country that are looking at things like being quite multi-purpose, of doing not only housing, but doing student housing and nursing homes and hotels, so that they can really spread the cost of that upfront factory investment across a larger and more dependable pipeline of projects. So if you could address what your work has been around that, what your thoughts have been, and whether I've got it wrong.
No, you don't have it wrong. All of our work so far has been single family, although we are working with some multifamily developers in the Twin Cities doing multifamily modularly. I know hotels, student housing, other facilities like that are mainly on the two coasts, they're doing a lot more of that than we are here in the Midwest. When we decided to go modularly, we thought cost savings would be the primary reason to do it. It's really not cost savings at all. The costs are pretty comparable. There's a couple of reasons for that, but the advantages are quality. For the same price, we can really deliver a much better quality house than I could have done as a stick builder building conventionally. And I don't have time to go into the proof of that, but the quality is really different. And the second thing is the time. I mean, our first house we built in 2 months, 60 days, 62 days actually start to CO, which is in the city is pretty fast. And the time savings for multifamily is even more significant. In a multifamily, your interest savings in a single family home is kind of insignificant, but when you're talking about a $15 million 80-unit multifamily building, all of a sudden the cost of your money really starts to mean a lot more. If you can cut that time in half and deliver a better product, or at least a comparable product, you're really ahead. And the third advantage is sustainability. We use one dumpster for each of our houses. We used to use 3 or 4 or 5. So because everything's done in the factory, they're much more waste conscious, and they have their computers running a lot of their cutting equipment, so there's just a significant amount of less waste. And I've already forgotten the first question.
First question was about the difficulty of doing secured borrowing.
And we understand completely that construction lending is pretty risky. Right now we have, we wouldn't initially be looking for development financing. We have buyers that we could sign a purchase agreement with them within a month, but they have end mortgage approval, but no construction financing approval. We have a hard time finding, well, we haven't really gone out and looked for it lately, but we have a hard time finding kind of interim construction financing that we can use on a house-by-house basis for a buyer that's already signed a purchase agreement and is going to buy that house, which is a little, I mean, there's still risk involved, but there is a lot less risk than excuse me, than other development lending. Other than in terms of ideas, I'm not a finance guy. I've been in construction my entire life. So is my dad, my grandpa. So that's kind of one of the reasons why I was excited to be here, was to kind of learn or get maybe some information about some of the financing possibilities. So
that's why we sat you next to Nicole. You know, and that is part of it, matching some of these partnerships up.
That's absolutely part of it, yeah.
I think we need a break. I think we're off our schedule. Oh, go ahead, Rochelle. Sorry.
I was just going to ask if Keenan could talk a little bit about new construction financing and how that works, how it might be different for first-time home buyers, because in this market, building new construction a lot of times is just as is about the same price as buying existing. So if you could talk about the availability.
Well, sure. And you've heard a lot up till now about how that's transitioned a bit and the higher end housing that's really being built just because of the cost per housing. That's one of the things that I think we could look at, and you've heard before, I think, is looking at apartments versus condos. Like, when do they make that decision? Do we need to make that more accessible? From an end mortgage standpoint, there's two ways that we can help someone finance a home construction build. One is to somewhat provide capital to the builder, developer to have them build the home, and then we just come in with an end mortgage takeout. That's a traditional model. A lot of times, builder, developer won't have the wherewithal to do that, or will not want to carry that risk. They'd rather push that off on a lender. So in that case, banks, mortgage companies will come in with construction financing. So now we're moving that loan, instead of being done to a builder or developer, we're now lending to a consumer. They're the stakeholder, they're the borrower in that. So they've got skin in the game, and we would lend to them. That helps because it diversifies the risk. Instead of lending to one builder that's building 100 units, we're lending to 100 different individual consumers. So if that builder goes insane or develops a chemical dependency problem or wigs out for some reason, the risk is reasonably mitigated versus a single borrower losing their job, something adverse happening. So it's a way to diversify the risk and also to free up the capital. What you need to be able to do is you need to be able to work with a financial institution that has the wherewithal to do that, because most of our mortgage financing comes from our secondary markets. Even our very trusted and good suppliers of that don't have that construction financing vehicle available. Minnesota Housing, to my knowledge, doesn't lend directly to consumers for construction financing, for example. So in the case study I described before, if that consumer wanted to take out that Minnesota Housing loan, really needed to find an existing home, there wasn't a construction loan option to bridge that gap. And there's a lot more to talk about with that, but as you might imagine, where the risks are higher for construction lending, that flows through for banks and financial institutions at all levels, whether the borrower is the builder or the individual. And so when those risks go up, so do the credit criteria, so it becomes harder to obtain those loans. So especially in the more affordable arenas, we're finding that can be problematic. Did that answer your question? Thank you.
Can it be more expensive also in the end?
Certainly, yes. Obviously, many of our loan costs are tied to the amount of financing. So if I need a $40,000 loan and an appraisal is $400, that's 1% of my mortgage amount. If it's a $400,000 loan, it's 1/10 of 1%. So just to give you some flavor on how that scales up. And just to put in perspective, the numbers here, 40 a year, maybe 125 if you hit your goals. We're doing those sorts of numbers a week by way of mortgage fundings. So with that said, it's good work, but we need to find a way to scale that up and get more. It's got to be more than just onesie twosies.
Okay, any other questions? Well, do we want to give them closing comments? Or are we over? Apparently not. There was,
All right, you've been wonderful. We're just behind on our schedule.
So, well, I want to thank everybody for coming and speaking to us. So thank you. Back at 11. Okay, we'll take a brief break here, and let's try to be back here by 11. Thank you.
Let's start up again in about 5 minutes.
I'm like, wait. Oh my goodness. So Monday. So Monday morning. Is that the, I put that. I heard that. Yeah, yeah. I'm looking forward to coming.
All right, folks, if we could get back to our seats, we want to get started. We're going to work through these next items, kind of collapse them together so that we can honor the time that's on the agenda for public input at 11:45. So I think now we're going to turn it over. Now after we've had that really great panel, we're going to talk about putting together the report. And so each work group's been asked to provide an update for our meeting on April 20th. Apologies for the vacuuming. There's apparently some rather yucky stuff being trucked on the floor, so they want to take care of it sooner than later. So yes. So each work group, we have to provide an update on our meeting coming up. We've been asked to consider some language around elements that we're going to put in the final report framework and provide suggestions and identify which ones we want our work groups to work group recommendations to fall under. Merritt's going to talk a little bit about making method out of this madness and walking through kind of the report structure. And then Casey's actually going to walk us through the elements themselves. So I'll turn it over to Merritt and Casey.
Yeah, I can start. Not at this moment, not for this slide. We have one that follows on the recommendations. So just the overview quickly for the report structure. The idea is that the report that will come out of the task force at the end of July will have a large vision statement that encapsulates kind of all of the work of the task force and sets the tone for key elements and recommendations that would be included in the report. So we start with an overarching vision statement. We have a handful of elements that identify what we think is important to advance a resilient and stable housing system in the state of Minnesota. And then under each element would be a set of recommendations. In addition, under certain recommendations, there may be interest in identifying potential tools or strategies that could be selected among to advance that recommendation. But at this point, what we're asking the work groups to focus on is looking a little bit at the element language, and then we'll get into discussion about recommendations that might come from this work group. So across the structure of the report, the elements might cover one or more work groups, and the recommendations under them might cover one or more work groups. So it's where everything gets pulled together. So as an example, we would have a statement, for instance, for element 1, provide access to housing and remove barriers. All Minnesotans must be able to access housing they can afford. And the report would include a description of context, sort of key needs, who's impacted, what's working, and then where are there gaps and what's not working. And then for that element, there would be a set of recommendations. Again, some might come from this work group, some might come from the other two work groups. And we also want to keep in mind that there is interest in looking for recommendations that may be kind of new stretch ideas or innovation, in addition to recommendations that people might be a little bit more familiar with. So doing both. And then again, there could be tools and strategies listed for some or all of the recommendations. So today we're just talking through the elements language very briefly, and I'll turn it over to Casey for this.
Elements to set the stage for recommendations. Under element 1, provide access to housing and remove barriers. So all Minnesotans must be able to access housing that they can afford. I don't know, because you've been more attached to this, if you want to talk about kind of where the next steps are or where we're going with them. What do you think?
Yeah. So on the elements language, for the next task force meeting, we're going to have a little bit of discussion with the task force to see if the language in the 6 elements, 3 are on this slide and 3 are on the next slide, if they seem to encompass everything that the task force feels it's important to articulate for the report and to encompass the range of recommendations they would have. So we just wanted each work group this week to quickly look at the elements language and to think about if you think it sort of captures the types of things you've been talking about. And it could be that 2 or 3 or 4 elements relate closely to your work group and 2 don't. They may relate to the rental work group or the housing stability work group. So just see if you think this language captures what is important, or if there are any gaps in the language.
So with that background, element 2 is enable and support housing stability. So strategies must be in place to ensure that Minnesotans can maintain stable housing connected to transportation, jobs, healthcare, education, and other services. Element 3 is providing pathways to homeownership. So a path to homeownership must be clear and available to all who seek it and have the resources to support it. So as we move forward in looking at the 6 different topics and themes that the homeownership work group has been looking at, you'll also want to think about the elements and see where those may fit in, or where there might be some potential gaps, or where some wording may need to be adjusted for those pieces to fit in within those different areas. Moving on to element 4, address the need for housing preservation. Preservation of existing ownership and rental affordable housing is essential, whether it's naturally occurring and subsidized. Element 5, provide a range of housing options, and that's expanding the range of housing options by providing type and financing to better match the growing and evolving needs and interests. And element 6, ensure safe and decent quality housing standards, and ensure that Minnesota's housing stock is decent, quality, and safe, and that basic standards for quality and safety are essential for all housing. So as the work group begins to look at some of the topic areas and solutions that has been discussed at previous meetings, we can revisit this piece after that discussion to make sure that the group feels comfortable that those topics are encompassed within these 6 elements.
This is just a reminder of the 6 topics that your work group had identified from the start. In the kind of medium blue color are the 3 topics that had been addressed at previous work group meetings. In the dark blue at the bottom right is the topic that you're covering today, and the light blue are topics to be coming up. So as we get into the recommendations discussion today, we'll be focusing on those first three.
Yeah. Okay.
All right, in front of each of the work group members, this document titled Homeownership Work Group of the Governor's Housing Task Force on Housing, Summary of Potential Topic Areas and Solutions Discussed at Previous Meetings. So this has been further refined from the last meeting based on discussions and trying to organize it in a way that works in framing the discussion for the work group members. Now, one thing that's important to note is that these are not final recommendations. These are discussion items that have been brought up at previous meetings, both as discussion topics that the work group had either mentioned as potential recommendations, and these are all items for consideration for the work group to help you frame your discussions.
Do the work group members who are on the phone have this document? Okay.
Yes, they do. So with that, I will turn it back over to Terry and Mike to help lead the discussions with the work group members.
I wonder if we had a good discussion about the first three topics the other day. I'm wondering if Mar, this is the first time if Mar, are you still on the line? If you have any reactions to any of the recommendations that we refined about section topics 1, 2, and 3, and obviously I offer this up to our the working group members too. If maybe we've had some additional time to think about it, to add any comments or additional pieces. I do actually want to spend a little bit of time, since we just had this great panel about access to capital, maybe kind of forming some pieces from the panel we just heard from today, or if we have any initial conclusions we've come up to. But I do want to give Mara an opportunity to reflect.
Sure. I think that one of the things we, as I was asking earlier, that we have to keep exploring is how do we gather that information in what are the gap that we're talking about? What are the pieces to that gap? And again, it cannot be only the credit score. So there's more to it that I think is going to be maybe hard for this time frame that we have until July to gather all that information. But if we could maybe gather more stories of the different people in their work, of how those gaps play out.
And Mara, for clarification, are you talking about education gaps as it relates to topic 1, or the access to capital gaps, or just overall?
Overall, yeah.
Okay.
Yeah, because it has many pieces. Is the access to capital, is the mindset of the NIMBY and how we change that. And we had a panel the other day talking about when people buy a home, they want to preserve the existing neighborhood the way it is. So all those pieces are at play here.
Yes. Yeah. I think Mara, I think that's a good point you made about the about the consumers, which I think is under topic 1 under concrete action, but I don't know where we've addressed particularly the NIMBYism comment about how do we address, do we want to take concrete action to say, to talk about that in our recommendations, because the perception issue, is very real.
Yeah.
So yeah. So Casey's shaking her head saying we can add that, Mara. So thank you for bringing it. I don't know if anyone else here feels like we wanted to add to that, or isn't.
Terry, I'm really struck by the discussion we heard this morning, that even though you were hearing from financing people, overwhelmingly the thing that they shared was the shortage of inventory.
Yeah.
And I'm not sure which topic it's best to fit under, but my recollection is we heard that at maybe meeting number 2. And it seems like we don't quite have anything called out in these 3 topics.
So Mary, under expanding pathways and access to homeownership, under the 3rd section, it's addressing the mismatch between housing inventory and need preferences. So looking at housing type and inventory.
So I guess maybe I'm not understanding this particular piece. I was thinking that the recommendations are really the concrete actions that are listed there, and this other stuff is the subject of conversation today. So I guess maybe I'm suggesting we think about elevating that one or framing it up a little bit more, because I was just really struck by how every single speaker talked about inventory.
Yes, and Mary, you are correct. This should help tee up some additional discussion. So my recommendation would be to go through each of the sections, and then under the other items that have come up at work group meetings, having the work group members take a look at it, either have them move to concrete actions, really tease them out a little bit more.
Commissioner, I agree with you on that also. We discussed that the other day. The inventory has come up in every meeting that we've had. And actually, when we talk about these, go back to the elements here, of the 6 elements on this final report, 4 of them, inventory will address them. Inventory will have an impact on the elements. So I wonder if inventory shouldn't take a bigger role in this report, or and I'm not sure how the element sheet works into the end. I was told in the end our ideas would filter down and make their way into here. But I think the inventory issue has probably got to be one of our largest topics. And when we break it down into the topics that are on here, the inventory addresses quite a few of these also. So do we try to put elements from inventory into each topic?
So I have a suggestion that I think may get to that. So on the first page under expand pathways and access to home ownership, I agree that if the inventory isn't there, then it doesn't matter what kind of programming someone has gone through. I'm wondering if E under concrete actions to address gaps could be to articulate the gaps. So we talk about addressing the mismatch. It comes up another part in other parts of this document, but to call out a specific action, that being to articulate the gap in inventory existing funding with the dollar amount needed to fill it. Because I think that is one of the things that we talked about even last week in the public forum, is having a really good sense for what it will take to actually close these gaps. And so I think that articulating that could be an actual action step, because it then gives fuel to those advocates and other folks who would be seeking to secure those resources.
Any thoughts or reflections? That that'd be an explicit concrete action? Do we, yeah.
So I agree with Mary that bringing the idea of the shortage is one of the primary issues. And to Akula's point, we can have all the programs in the world, but if there's no houses, so what Keenan was saying also, there's drawers of pre-qualified buyers. There's no place to put them. And so what has come up when we're talking about why isn't there more affordable housing is building, and what are the issues with being able to build new affordable housing. So yes, I think that bringing that to the forefront and looking at what are some of the existing programs that our panel just spoke about regarding modular homes, financing that Habitat's providing, financing that Sunrise is providing, that if we can focus on that and try to expand that and make those focus items, that I think that would go far in helping to solve some of the shortage of inventory.
So do we restructure a topic here, or do we add another topic, or?
I think that it goes along with expanding the pathways and access.
We're also still, topic 6, we still have coming up about maintaining existing housing. And so I think it should be explicit throughout several places, but I'd be okay with adding an E and to be explicit about articulate what the mismatch is, because I think, sharing the information so people can see how the different stakeholders can own it is going to be really important. And I think maybe in the next, when we have topic 6, I think we can bookmark it now, be explicit with this action step, and then, wait to hear from that panel of information to get that information to inform us more about what, to more in the details about what inventory does look like. Would folks be okay with that, since it is an upcoming topic for us to discuss?
But doesn't that belong in each one of these topics? Doesn't the inventory belong in each one of these topics somewhere?
Mm-hmm.
Well, so for example, on topic 2, I would see it not necessarily, it being, I mean, they're all related, right? And interrelated, but I see topic 1 being different from topic 2, which is addressing the homeownership disparity, because again, if the units don't exist, then there's no way to address that disparity, but they're not independent of one another. I wouldn't necessarily see it fitting in topic 2 though.
I think the development of the new construction is its own item. I think that the rehab fix-up loan program that's in 6 is its own. And I think that expanding the idea and opportunity for homeownership, to Akula's point, is its own, separate. So yes, that they are all overlapping, but each item needs to be addressed in its own space with its own supporting factors.
I would agree.
So, are we okay with topic 1? We're going back explicitly through topic 1 around the adding a section E. Topic 2, I want to just move through this, address the homeownership disparity and what's working around the Opportunity Alliance, and then concrete actions around developing toolkits and marketing materials, so that they can be duplicated throughout the state. Are any other thoughts as it comes up with the content, the other items that we've talked about addressing the homeownership disparity? One thing that I've seen that Minnesota Housing does is like a dashboard. I think we're only as good as when we hold ourselves accountable to reporting. So to some extent, I think we need to be explicit about reporting, right? And encourage this public reporting kind of tool. And so I know at Minnesota Housing, we keep it kind of buried in our affordable housing plan, right? And so, but I think we need to pull it forefront. If this is the gap we're trying to close, we need to be explicit about it. So I would put in a recommendation B, but a concrete action is to the extent we can, to put out a report or be explicit about how we're meeting this gap.
So publish and socialize.
Yeah.
Dashboards, is that?
Yeah. And in
And when we were talking about the concrete actions to address the gaps in topic 2, that really was sort of what we talked about, was the programs that are available and funds that will run out, and how it's hard to keep people aware of that. And so having sort of a matrix that's available to everyone, that consumers can look at, realtors can look at, lenders can look at, that is uniform, because a lot of these programs are out there and available, but it's very hard to keep track of what is existing, what still has funds. And so I think that it got sort of pared down in this sentence, but that was part of the idea when we got to this statement, was what those programs are and making it uniform in public, and making that publicly available, whether it's through a website or professionals or whatever.
Terry. To follow on from what Rochelle just said, I was really intrigued, quite honestly, by the notion. It's it's an out-of-the-box thought of whether you could somehow create a single pool that communities could pledge money to, let's say, in exchange for, getting back enough homeowners in their area to meet, their requirements, but to have it be a little more flexible so that home buyers moving from Brooklyn Center to Brooklyn Park to Coon Rapids, as they're trying to find a home, wouldn't have to qualify in every one of those communities for the assistance that's available. It boggles my mind a little bit about how you would do that operationally, but we're not here to be boggled by operations. We're here to have big ideas. And I was really intrigued by that if there was some way that you could kind of pool those resources that are coming from places other than state funding, because, we have one big pool for state funding, but to have that also bring other funds to the table in a way that they'd be more mobile. It's really intriguing to me.
Okay. Yeah, so there are a bunch of things that are starting to kind of coalesce in my head that I think your comment just helped further along. So one of the things that I was thinking may be missing from what's working is this whole, and I don't remember what the program is called, but it's funding for navigating through the homeownership process, which we heard about in the first task force meeting. We've heard about the absence of that and the kind of instability or insufficient supply of resources to address that. So I would like to document that, and I don't know how we talk about it. I don't want to wordsmith it, but adding as point B under what's working, something around navigating the homeownership process.
Yep, and I believe what you're talking about is the funding for the HECAT, Homebuyer Education, Counseling, and Training that was discussed, that also includes the funding for financial wellness.
Yes. So adding that as something that's working. And then that then spurs to me like a specific tangible action related to that. I think that's where that trust fund with local investment could be really helpful to fund that. One of the things that, and so the public forum in Little Falls is still fresh in my mind, but one of the things that just kept coming up in multiple ways for me was the desire to have, to not just have government engaged in creating the solution, and to identify opportunities, really tangible, practical ways for the community itself to kind of weigh in and be a part of the solution. And I think that trust fund idea could be a part of that, including philanthropy, to the idea that was suggested by, and I'm blanking on the Sunrise Banks. Nicole. I think there's parallel between that, what we heard in Little Falls, and then what Robin kind of spelled out in terms of some of that baseline funding as well. But I think that the local housing trust fund could be a tangible action related to that.
And to add to Akua's statement, one of the statements that came up several times at that meeting in the smaller work group was, how do we engage employers in also contributing funds, either for down payment and closing cost assistance, or partnering as far as offering homebuyer education and counseling. So that was something that group was very interested in the work group considering as well.
I have a question on that also. How do we better match the funds with the inventory? So what good is it to have the funds if you don't have the inventory? And will that help with the donations if we match the funds better to the inventory, and will that push the creation of inventory?
That's exactly the point that I was trying to articulate on the for part E on the first page under topic 1. I think that's exactly right. And to Rochelle's point, to have a kind of constantly running dashboard that's keeping track of that, keeps everyone honest and provides an opportunity, like a tool for accountability.
Did we get any type of summary from the Little Falls Forum at all, or not?
Not yet. It was just Thursday night,
Okay.
so we're working on it.
Was the inventory an issue for them also? It was.
So inventory was an issue, and this broader conversation about public will, which I don't even know, as I'm thinking about it now, if that's a part of the elements, but if it isn't, we should consider adding it. And maybe it is and I just missed it. Inventory was a big challenge. One of the complicating factors is this broader conversation around who represents the community and who comprises the community, that I think is important to creating the public and thus political will to create the inventory. So there's this kind of a cycle, an interdependent cycle, and I think that public will is a big part of that. So there's resources and access to capital, which is a constraint, but there's also the public will to create the units and be welcoming.
Mary? One other thought that came up this morning that I think fits well under topic 2 is it was clear to me that there's probably more appetite out there for alternative mortgage products, even though we have a couple of good, really excellent models in both Habitat and Sunrise Banks, that there probably is a bigger appetite for that kind of capital. I was talking to Nicole after or during the break, and she was talking about the fact that they've been making mortgages now for 2 years, alternative mortgages, and they have 0 defaults. And so the idea of maybe a secondary market for loans that are seasoned, so that those banks that are willing to put that kind of capital on the table can kind of replenish their capital potentially. But it just struck me, just hearing Keenan and others talk about the fact that while the regular mortgage markets have freed up some, you still do have FICO score issues, and I know that Robin mentioned stability of employment being another one. To have kind of that interim product that helps people get into homeownership, even though they might not be quite ready for a standard mortgage product.
So to piggyback off of Commissioner Chingerthal's point and tie it into this, maybe what's working, we could add C, which is alternative mortgage products, and maybe we articulate the ones that we've heard from, particularly because we can speak to their success rate. And then a concrete action could be something related to expanding their use, particularly for a specific type of lender, for instance. Do all CDFIs, Commissioner Chingerthal, are they leveraging these products? Could that be one of our recommendations, is that they're looking at those products and expanding the offering?
Don't we also need to look at how to move those out into greater Minnesota?
Exactly, right.
That kind of struck me as it's the large banks in the bigger areas that have the ability, the resources, and the product. How do we get it out to our smaller community banks? And I think Nicole was right. That should be the requirement of the community banks to administer that. But that's going to be tough in small communities.
Well, and Mike, to that point, and I think Keenan would probably agree, the level of the order of difficulty of originating mortgage in a compliant way is like dramatically higher than it was 10 years ago, which I think by and large is a good thing. but it took really deliberate action by, Sunrise Banks didn't used to do mortgage lending at all. They made a conscious decision post-recession to actually start up a mortgage lending business. And by and large, community banks don't do a lot of single-family mortgage lending unless they're doing, just straight down the middle of the road, something that they can sell to a correspondent bank. But, having a mortgage origination shop in a community bank is not typical.
Well, we see it in our bank, our community bank in Rochester. We do quite a bit of mortgage lending. I think if it's a growing community or community banks, that's an avenue for them to make some money at. But you're right, it is very difficult. Smaller banks, smaller than ours, you probably don't have a mortgage department. But part of that is our fault through regulation and actually sharing some of the ideas. Because I think your community banks truly are committed to the community, and that's something they could probably help administer better than your large banks. So instead of discouraging them to get out of that, we should try to encourage them to get back into the lending. And that's a niche that they could fill, that they can win over from the big banks.
A question of procedure here. I think that I'd be most in favor of that as a recommendation. I'm wondering if it's one that we list under topic 4 as opposed to topic 2 around the homeownership disparity, since it's that one specific about capital as what's working, and a recommendation A, what's working on alternative mortgage products, and A, concrete action is to encourage more sharing to specific audiences, i.e. other community banks. Would folks be okay with us starting to create a recommendation in that topic area?
Yeah.
Okay.
But you said outside of topic 2?
Oh, yeah, it would be under topic 4, but since in light of what we just discussed today around increasing access to capital. We haven't started, but I think the panel information is just so fresh in our minds, so.
I think, on a personal, I would love to have it live in topic 2, just because I know that that's the community that's probably most likely impacted by those more traditional.
Okay.
That said, from a political viability perspective, then I put my other hat on.
Yeah.
And I think it might be more viable under topic 4.
Yeah.
And just for the way that this is all going to roll out, if I understand, is that an action step may be under multiple.
Yeah.
So even though we're placing it in 2 or 4 right now, it will still get carried out.
In multiple.
Yeah.
And that's
relevant because to Akula's earlier point, so many of these things overlap and relate, and then.
and that's a point that came up the other day as we come up with these ideas, recommendations, what's working, what can change. Let's just keep the ideas and then we'll work out where they belong as we get further down the process.
And Mike, we're getting feedback from those on the phone. If you could speak closer to the microphone so that everyone can hear you.
Thank you. Great. Is there anything else to add about the topic 2? Anything else? Okay, topic 3, there's quite a list here of what's working around, and then concrete actions too. Anything we want to add or change or shift here? I know there was a separate work group that was working on local government policies, so I think I don't know when we're going to report out of that, or they met once, correct? And then we'll hear some more information about additional pieces around state and local policies.
Yep, we're still formulating the notes because that also just happened late last week, but I don't know if there's just a few points that you may want to just summarize from that meeting.
Yeah, it was a good meeting. It was good. I got a lot out of it. On one hand, you've got builders and developers saying less fees, and the other hand, you have cities going, just build affordable housing and everything will be okay. So I mean, both parties have some work to do, and I think just the communication needs to be better, and I think the work group was a great step in that direction. I think we do need to get more input. I really would like to see more input from the private sector on this. But, you know, that's been my theme through this whole process. The private sector needs to provide more input on how to solve some of these issues. But in a lot of the stuff that's in here, I think goes to some better partnerships between builders, developers, and communities. You know, the one point that came up that I kind of walked away from is you got all these projects around that, you know, for years I've always been told, develop the jobs and the housing will follow. That's kind of been our way of thinking forever. You know what? It didn't happen. We spent all this time and money on developing all these jobs, and then the housing just got ignored. And I think there could be a better partnership as we look at creating jobs. I mean, Rochester is a great example of that. We've got Project DMC creating all these jobs, and there's no component of that at all for housing. So how do we take a step back and take a better look at the housing component as we create jobs, create businesses? I think it's something that we need to take a better look at going forward. And maybe that's a recommendation that comes out of here. And maybe that'll drive some state and local policies and regulations. You know, the regulations piece is just a swamp. I mean, it really is.
Getting to your point on jobs, Mike, one of the numbers that really stuck in my head from the Little Falls discussion was from one of their employers, Centra Care, which operates out of St. Cloud, but also throughout central Minnesota. They have 130,000 employees, and they have, 13,000 employees, and they have 800 job openings right now. 800 unfilled job openings out of a 13,000 employment base.
You know, and housing goes a long way to help fill those openings. It's huge.
Right, and that was why they were there, to talk about the fact that they simply cannot figure out how to attract people if there's nowhere for them to live.
You know, in saying that, if a community truly does want to create this housing, then I think there's got to be a table they come to and discuss some of the barriers in that community to create not just housing, but the housing of the type that they need.
So there was a subsequent conversation with business leaders the following day that spoke to that very thing. So someone, an employer, and I'm blanking on which employer it was, had purchased a recently vacated hotel to provide housing to their folks, and were busing them to the hotel for work. But after, say, 90 days, those individuals were looking to kind of put down roots and to stop shuttling back and forth. But the housing doesn't exist for them to live, and then the political will doesn't exist for those units to be built. And so I do think, to your point, there's a huge role for the private market to create that public will and to leverage its brand and the contributions that it's making to the broader community to move people along in a way that supports their best interests. But I think that there's some courage that needs to be developed there. It did sound like there was a housing solutions group that was being run by the United Way there, and Central Care was a part of that. It sounded like a number of members of the chamber were there as well. But I think that there's a lot to be gained from private market engagement.
No, and aren't you seeing a lot more? I don't know, the communities are more receptive to some ideas right now. I mean, as we talk about some of these programs and having employer involvement in them, these involvements should be starting at the time that they're talking about expanding or creating jobs. And I think you see an appetite for it right now. But what I think is missing is solutions. I mean, we keep talking about it, but what are our solutions? And that goes right back to inventory. What are our solutions for our inventory?
Well, and Mike, while I would say that certainly there have been more employers coming to the table to talk, there hasn't been a tremendous amount of action by employers to actually step up and be part of the solution. The other thing I would say is it's very clear that resistance from communities to things like higher density that comes out of a fear that communities are going to change, they're going to be different, is really working against the reducing the costs because of the lot sizes, et cetera, that are that end up being, variances being granted, et cetera. But we've seen that everywhere from St. Paul with the Ford site to St. Cloud with just not wanting to accept higher density as part of the solution.
And that goes back to something I said earlier, maybe the time to have the discussions with the employers are when they're expanding and when they're asking for something from these communities.
I feel like the gentleman that came from DigiKeys spoke to that to some extent.
Yeah.
But I mean, that's still a rare example.
But I think the bigger piece is, I think it's these stories that need to be told, and where are these tables that need to be convened so that they can start to share, and and then subsequently get that narrative out in community, right? So we're expanding. We need more people. Community members hear this, so it's shifting that public will, but really starting with, telling those stories of where it's worked and sharing best practices as well as process. What does it really need to get done? Because I think that's where, communities are also, not only is there the fear, but then they're also reluctant if no one else has done it before. And so,
Could that actually be one of the action items, is to convene a group of employers on a regular basis to be a part of the solution building?
I think that could definitely be part of the action step, is to encourage local communities, especially we talked the other day about economic development arms, because sometimes they're the ones that are hearing the stories first. And so whether that's an HRA or different cities or a chamber, to really start to think about how they convene and have those conversations. But I think I don't know if we're as explicit in that in the recommendation yet, but I think we want that to be.
I would love to see us be specific there, and not even just encourage, but, a recommendation be HRAs, for instance, gather employers in those areas that work with their local chambers.
Something that we've talked about just a little bit at the task force level, but I think it needs more visibility, is the threat of the shortage of housing to the economic competitiveness of Minnesota. And I'm remembering back to the panel where Brad Hewitt talked about the fact that as an employer, and as a very engaged and compassionate employer, that they've really never thought of having a role in housing. They've thought of it, as being a competitive advantage of being able to recruit people to the Twin Cities, and now that advantage feels like it's slipping away. But it hasn't yet risen to the, oh my gosh, we need to take some action. So at least in the metro area, I would love to see greater MSP, for example, address the issue of housing, because they just have not paid a lot of attention to the issue, and finding other voices besides the voice of the task force to talk about economic competitiveness as being threatened by the lack of housing, I think is a big one that has to be out there.
And Commissioner, back to your point about this density, the community is not welcoming the change in density, the change in product. I think that's a product of our planning, zoning, our comprehensive plans, our land development manuals. And it's not, part of it is the drive to create more affordable housing. The other part is it's the product that people want or need. I mean, if it's the aging or the younger, single-person households, what have you. And of course, the community's first reaction is going to be, no, not in my neighborhood. But I don't think there's a good enough job. I'm kind of interested in Terry telling me about the Met Council's input that they have on, is it the 7-county area around the metro area, in helping develop their comp plans to meet the needs. You leave the metro area, we don't have that anymore. And everybody's working on their own comp plan. We have to make it more acceptable to change the housing style and type and density. And we don't do a real good job of that. And that's both a private and a public issue. And there's back to that city developer partnership.
So I would just add, and I know we're running tight on time now, but I would just add that I think that resistance to density could be, is oftentimes regulation in more kind of formal deals, but I also think it's biased. And so I think we've got to be real and name it. Maybe it's not necessarily in these recommendations, but as like in the setup, we've got to be real about the fact that sometimes density is coded language, right? You know, we don't want more density, means we don't want brown people. And so I think we got to be real about that too. That's not, and that's not to say that anytime someone is resistant to density that's the reason, but I think it definitely informs some of that fear that we sense. So I just think I would just add that up for additional fodder.
Yeah, thanks. I'd like to add into that because that was definitely clear in the most recent forum, and some of the concern even came, you know, what does it mean to have people come here to build housing for people that weren't born in Little Falls? So I think there is a part of just what does change in our community look like, who's coming, and I think a real disconnect sometimes in people understanding that more affordable options are for people who are working full time. So that the employer that said they need, you know, 800 more employees said that almost all of those employees would need housing that probably qualifies as affordable. And it doesn't seem like that message is understood. But also want to reinforce what Akua said. It's just, there's definitely a concern about who would be coming if we build this housing. Do we like those people? Are we comfortable with those people? And it sounds like that narrative and the challenge of that has really shut down conversations, at least in that part of the state, because it's really tricky stuff for communities to talk about.
So just one more nuance I'd add to that is that, you know, I think it was more pronounced in the last forum. I don't think it's unique to Greater Minnesota. I have experienced and felt that even in our metro area. So I just want to make sure that we're not just painting it as a black and white contrast. It happens here. It's happening here.
And ultimately, isn't that each community's decision that they want to grow? I mean, if you're going to grow, here's some of the things that are going to happen. I mean, you can't have both. You can't grow and then not change some of the housing stock that you need. So, maybe we could do a better job educating communities on, if you're going to make that decision to grow, if you're going to support this plant coming to town, creating all these jobs, here's some of the issues.
Or if you're going to survive. Like, I think it gets that granular. If you're going to survive, this is what has to happen.
Mar has a question online.
Yes, thank you, Akua, for your comment on what happens with people of color or low-income people. Is always the other people are coming to our neighborhood, and that fear of the higher density that is hiding other issues and the biases. And I would like to also add, in the call for ideas, if you went through the list, the people from the North County Foundation about the manufactured homes, and because those are homeowners of the trailers, but they're not owners of the land. So that it opens the potential for in the whole state for how do we face the fact that those people can be out of their homes if the trailer park is sold and not kept as a trailer park. So how do we manage those transitions? Because we have the potential of many people being true homeowners of both the trailer and the land the trailer is in. So that we should also add that it's not a huge amount of people, but significant.
Mm-hmm. Yeah. Okay. All right. Do we have any other, thank you, Mar. Do we have any other comments? I think we were slightly over the time we wanted to keep for the public input session. But I think especially, okay, we can go to new. I would say that let's spend the last 5 minutes thinking about what we heard in this recent panel about increased access to capital. We heard about some things that were working well. Does anybody have anything that rose to the top, as well as any kind of action steps that we wanted to take? So I made like a massive amount of notes from the panel, but is there anything that, in addition to the inventory, I think that was a theme that stuck out. There was this piece around secondary markets that emerged as a big theme. Let's see.
Well, I think I think there needs to be a deeper dive into the capital for the smaller developer.
Yes. Mm-hmm. Yeah. Mm-hmm.
I mean, that came up a couple of times.
Yes. Construction financing too.
Yeah, I mean, Gary's a great example, 40 units a year, and he's having trouble, which he isn't a small builder at 40 units a year, and he's having trouble with capital. Mm-hmm. Can you imagine the ones that are doing 5 or 10? Yeah. Mm-hmm. I think we need to do a deeper dive into that and try to come up with some, mm-hmm. I don't know, some good options and recommendations on what we can do to help ease that.
Mm-hmm. Mm-hmm. Yes. Smaller projects.
And I don't know, is there somebody else that we can go get some more input from, or is there some more research we can do to?
Yep, we can take a look at that and identify what would be most helpful for the group to put together.
Mm-hmm.
I'd like to see it even do something with the community banks and tie it onto what we talked about with the community banks and the products that Sunrise was using. You know, once again, if there's a correlation of the projects
mm-hmm.
to the inventory. If we can create the projects, we create the inventory. If we can create the product for the end user, tie them all together, it benefits everybody involved.
Any other thoughts or folks on the phone, Mayor Larson or Mar, if you had any reflections about the panel we heard about themes that emerged? And then we'll, sometimes if we think about the themes, we'll get some time to do some more reflection and come up with some of the great action steps that we can take as a working group to pass on to the task force. Akula?
The one thing that was brought up by the Smart Homes Builder that seemed to have violent agreement among the panel, but I think fits maybe with topic 5, is the use of modular home construction.
Mm-hmm. Yes.
Can I speak to that really quickly? We actually, when times were good, we owned our own panelizing plant. Got closed down in the downturn. But the ones that are out there right now only have so much capacity, and they're really busy.
Mm-hmm.
I mean, so I think if we're pushing a particular product, we need to make sure there's a production for that product, and maybe it goes as far as to help on the production end of it. The ease of setting up these facilities. Somebody else mentioned the shipping. I mean, moving these panels, if you're hauling them from one end of the state to the other, you're going to lose your efficiencies. The idea is to have these closer to where you're going to need them. So that might be encouragement of creation of these. And the panelizing plants and the trusses kind of go together. So it's kind of a package deal.
Mike, I have a question for you. As I look at research nationally, I see that there's some hope for technology within, newer plants for construction. I don't hear a lot of that in Minnesota. And I just wonder, in terms of preparing for session 5, or is it 6? 5, whether we need to push ourselves to hear from a supplier that is integrating robotics and new building materials and that sort of thing, because I'm not hearing it here in Minnesota.
you know, the panelizing end of it, or even the panelizing end of it, you see it pretty prevalent in larger commercial apartment buildings, wood framed. When you get down to the level of the home builder, the smaller single family or maybe duplex, it does produce a better quality, I believe, but then the logistics come into play. So can you actually get that produced at the right time to get it to the job site at the exact right time? And then here in Minnesota, it snows in April, so you know, you never know when the job site's ready. So there's a tougher scheduling part to that, and that's where the location becomes a bigger issue, and then their availability. I think you'll see your bigger developers or builders take it on quicker, but it is moving that direction. But remember, we're just coming out of this downturn. You know, so it takes a while to get those up and running, some of these plants and some of these pipelines and some of the whole process. But yeah, once the pipeline gets into place, the process gets into place, it will help considerably, I think. But I don't know how we encourage that. And we could ask for somebody to come in and speak to that.
Excellent. Well, we're at time, so thanks. I think we'll have a little bit of time at the end if folks are doing some reflection, but I'll turn it over to Mike to do public input session. So.
Okay, we've got Amanda Capps-Peterson. Just tell us where you're from and.
Morning, my name is Amanda Kappas-Peterson. I work as a policy coordinator for MICA, Metropolitan Interfaith Council on Affordable Housing, but I currently live in Shakopee, Minnesota. MICA does work around the metropolitan region, but I specifically wanted to talk about some things that are happening in Shakopee. A few years ago, I moved down to the cities after my son graduated high school to be closer to our employment. And we rented a couple apartments till we decided where we were going to reinvest our money. I work most of the time in the inner city and in the Brooklyn Park, Brooklyn Center area, but because of affordable housing issues, we bought a townhome in Shakopee. So my commute to my $14 an hour job in Brooklyn Park is round trip about 70 miles a day because of housing issues. In my community right now, we do not have the political will for affordable housing. If you talk to our city council, they are very honest about that. We currently have a very large NOAA affordable housing, but what is being built currently are new townhomes at $279,000 to start. New single-family homes that start at $319,000, and we have a 700-unit apartment complex which will start at a $1,300 for a one-bedroom and up to $2,200 a month. If you look at our employment in Shakopee right now, entry level is about $13 to $15 an hour. So young families that are currently wanting to live in Shakopee can't afford to live there. It's a good thing for me, I guess, that prices are going up. I purchased a two-bedroom townhome, which is about 15 years old, for $159,000 last year. And currently that same unit is going for about $175,000 right now with no investment, absolutely none. So I have a great concern with life cycle housing in Shakopee. We have a lot of older homes, especially in the older part of Shakopee, where our seniors are looking to move into assisted living. Our current assisted living places in Shakopee right now are completely full and have 2 to 3 year waiting lists. And to rent one of those older homes, you're looking at about $1,600 a month. I'm just going to back up a little bit to give you a little reference. Prior to purchasing my home, I rented in Hopkins. The first year I was there, one-bedroom apartment. It was $970 a month. By the time I moved, it was $1,300. 2 years later, $1,348 a month, and to renew my lease, it would have been $1,595 a month. So to look at affordable housing, people trying to transition into home ownership, obviously we're making it at lower wages. Incomes, as we've discussed today, are not rising, but we're paying exorbitant amounts in rent, but yet the financing can be an issue for most people. Even at 620, I purchased the townhome that we currently live on just on my own. I'm recently married because I had an excellent credit score. So I actually, without having my husband's income, because my credit score qualified better. A lot of families are not in that situation. And the last thing I want to point out is one of the good things that Shakopee did with when Shutterfly came in, because they've kind of gotten burned with giving tax benefits to new businesses. They had a contract with Shutterfly. Shutterfly said that they would have X amount of jobs at X amount of rate by a specific time. They did not fulfill that, and they had to pay back some of those tax exemptions back to Shakopee. So that's another option we could look at, and when we have employers move into our communities, that maybe if you're not meeting what you're saying, then you pay some of that money back, and it could be directed towards affordable housing. You know, if we're gonna have businesses come into our communities where Shakopee has room to expand, so I see that a lot for the future is, okay, so you're gonna offer a starting wage at $15 an hour, what are you gonna give to the housing stock? So the community members that work here can actually live here, because we're losing all those tax dollars going into other communities. Thank you.
Thank you.
Hi, sorry. My name is Linda Soderstrom. I live in Bloomington at this time. I lived at Crossroads at Penn in 2015 when 2,350 people were given 30 days notice to leave. I met some people there when we were community organizing who would like to buy homes. One would like to buy a manufactured home in Arkansas someday soon and rescue horses. Another is a woman from the deep south, apartheid in America, 70 of age, who she would like to own a home so her grandkids have a place to play. She finds renting on Section 8 to be very insecure. And another couple I met right across the hall were catering weddings and so forth from an apartment so they could buy their own home, which they did succeed in doing. So lots of people you might not expect want to own a home. I did own my own home from 84 to 94 in the Powderhorn Park community. I was duly licensed for daycare and foster care there. I had 30 daycare and 30 foster care kids in my care over a 10-year period. And obviously that wouldn't have been possible in an apartment, though I was licensed in an apartment prior to buying the home. One of those people stayed in adoption with me. And again, the immunization or inoculation behaviorally of that person, that one adoptee who's now 30, we know that when foster kids arrive in a home before the age of 2 permanently, that they don't become victims or perpetrators or end up in prison, or it cuts way down on chemical dependency and mental health issues that they have. So I'm sure I just represent one slice. There are many, many subpopulations like this for who a home really, really matters. It's probably the single most important thing I've ever done. We only owned that home till my son was 8. But the type of prevention and intervention we could give him medically was so key and crucial. He's now had, and it's a little bit rare with fetal alcohol to have the same job for 10 years when you leave high school.
So I just wanted to kind of praise him. The other thing I wanted to say is we have some tools in our own community. We've had Matt Desmond out here. If you haven't read Evicted or looked into his research, please do. And we also put a lot of effort into a film called Sold Out, Affordable Housing at Risk. And it's worth a little bit of study. It's a 57-minute documentary at TPT. It's on YouTube, 24/7. There are 11 excerpts of it, too, in the same queue. And some of those are landlord-oriented. Some of those are, school-age children losing their cohort from moving around too much, losing their progress. We have people out here who built these cities, and they can't afford to stay there. We have school-age children who are changing their life trajectories by being bumped around too much. And I think that if it's cheaper to own, then we need to really establish bridges to owning, along with the education that it needs. And you do learn on the job as well. I found that out. So thank you very much.
We have Julie.
Hello. Just wanted to underscore a couple of topics that were discussed here today. First of all, the question of down payment assistance and a sort of centralized pool or some other method of funding down payment assistance, I think is really something worth taking a look at. I think the way that down payment assistance and closing cost assistance have evolved is one of the real systemic barriers to affordable homeownership today for a couple of reasons. Currently, some buyers will layer 2, 3, 4, I've heard of even 5 different programs of down payment assistance. And what the challenge that brings is origination is a challenge. So each one of those programs comes with its own requirements, its own paperwork, its own documentation, its own set of questions for the borrower. And the individual administering that or the loan officer and the real estate agent pulling that together are challenged to understand all of those programs. It also, requiring that complex configuration of resources really hinders the borrower's competitiveness in a purchase deal. So anybody who says, here's my bid on this project, but if you can just sit tight, seller, while I go make sure I can get all 5 of these programs, that'll be just great for me. And in the meantime, that seller is selling to somebody else who doesn't have those programs or who has cash. So it really places a stigma on the consumers who require those resources. We've recently recommended to Mayor Fry that the city of Minneapolis look at changing their down payment assistance programs so that they look more like a savings account that goes with the borrower. I haven't figured out all the logistics, but so the borrower can say to the seller, look, I have this money. This is my down payment, just like the person over here who's been able to save up the down payment from help from their parents or their family members, et cetera. So really underscoring the need for us to look at wholesale changes to how down payment assistance works. And the other thing I wanted to stress, we had a wonderful community gathering in St. Cloud this weekend in the Somali community. And we heard over and over again something that Robin Bites Tim brought up, which is stability of employment for many of the people that we talk to is really the factor that prevents them from getting a loan. They have cash. Many of the folks around the table that I sat in on have the cash for the down payment. They have good credit, but they pursue jobs to better feed their families and raise dollars for their families, and they don't stay in they don't stay in low wage jobs for 2 years at a time when they recognize the opportunity for moving up, and that's a real hindrance for them to get a loan. So thank you.
thank you to everyone who came for the public testimony, for the public input part of the meeting. The next thing we have to do is get input on, just confirm our input for the upcoming task force meetings. We are presenting on what the work we've done so far. We talked a little bit about the elements language earlier, and staff will summarize that. In addition, we came up with some really good ideas today about recommendations, and staff will have the next challenging task to summarize and offer some suggestions. I know some of the ones, especially in light of the panel, were a little more formation phase, but we'll have some place where they'll be written down. I assume, Casey and Merritt, will we get it before the 20th to review? Will the working group members get what we've incorporated today? So we'll have a chance to look at it before we present it at the meeting. Do we have any, it's really neat about these elements is that, do we have any, feel comfortable that we're forwarding any kind of stretch or innovative ideas? Is there anyone that's just, yeah, let's go for it, right? Because I think I think what's really neat about this opportunity is that we're able to push some things that maybe, we're a little like out there, but we want to keep it on our radar screen, because at this point, there's lots of different, we realize this is going to take multiple types of solutions, stakeholders. So I just throw it out there. Is there any big idea that folks have been thinking about or you want to incorporate as it relates to the homeownership working group? No big. Akua has a big idea.
Generally, but not today.
Yeah.
I was just going to make a plug for it. So I know this is our initial pass at recommendations, and just for the folks who are following along, this isn't it.
Yeah.
I do think that once we kind of nail down some of what we already know is working, it may free up our brains to consider and delve into more stretch ideas. And hopefully it's not just one, but that we permit ourselves the space to think big, to the point that you made, Terry. It is a once in a generation, at least, opportunity. At least that's how it's turned out this way, to think big and to not be constrained by a current paradigm around homeownership opportunities.
And, thank you. Rochelle?
I was just going to say, I think that some of the ideas are not necessarily novel or big ideas in themselves, other than we're looking at it and saying, hey, couldn't we do that more? So the idea, again, of modular homes is not necessarily new. It is existing, it is being used, but it's not being used enough. So that being a big idea that will be carried into the future for the next, 20 years, what will that progress into? The idea of allowing more resources to smaller, newer builders. Again, not new. Everybody started somewhere. How do we start to give those people more opportunities to build and to grow? And what changes will that bring? So I think that there are things built in already to some of the base recommendations that we're formulating that are not, again, novel, but just the idea of focusing on it and saying, hey, that works, let's carry that forward. That is the big idea. And so I think that, not to overlook that what we have built in here are transformative and will make a difference in the next, short time to the next 15, 20 years.
Thank you.
I would just also like to add that as the work group continues to refine these ideas and solutions, that there will be the opportunity to continue and refine. There's still the work group will still be looking at the call for ideas, as well as there are 5 more regional meetings to listen and to provide more feedback.
All right. Well, great. Well, I think
One more thing. One more thing, and I'll acknowledge that I had a chance to see the elements and weigh in, and I did not bring this up, but it's kind of really top of mind for me now. I'm curious to know if, among staff, work group members, if there is if we think there's benefit to calling out as an additional element, this notion around political will or public will. I don't know if it's something that warrants standing alone or how we would even word it, or if it, we're just intentional about baking it into an existing element, but just wanted to put it out there.
And I think I mentioned this before, once we get all of our recommendations or get closer to being done, hopefully that might drive some of the changes to the elements too.
You literally said what I wrote down here was about public will and the narrative of community change, right? And maybe the really novel idea is we're honest and not so Minnesota passive aggressive and Minnesota nice about things, that we're just honest about what we really, and about our fears as well as the potential opportunities too. That's a really big idea. So around that public will piece. But yes, so that's kind of our next steps. Thank you to everyone today. We have our task force meeting on April 20th. We will be at Wilder Foundation, a new location than we were before, and then we will be back here next month on Wednesday, May 9th in the afternoon, so to go over our next topic area. So otherwise, let me look at two directions. Continue to have the website where information is being posted, the overall call for ideas. Today we got a handout of what was just relevant to homeownership, but the other groups, if you're interested, are there too. There's actually an event coming up April 19th. That's a community solutions event. We'll be at Lutheran Social Services. That will be folks who have been really impacted by housing issues, hard to house folks who will be coming out, sharing their stories and coming up with solutions too. So we are going to get a dearth more of information and data, which is going to be great for us, and how this final report is going to be formed. But yes, so that's kind of the announcements from me. Otherwise, thank you everybody for coming. Thank you to folks in the audience for joining us today and to the folks on the phone. So with that, I will conclude our meeting. Thank you. Safe travels. With all that